Yes, I think we're going to pull back just like we're seeing, like I called for, but ultimately it's going to lead to a buying opportunity where within a year or so, we make new all-time highs, maybe even in less. Versus in the 70s going into the 80s, it literally took decades for gold to make a new all-time high.
The US dollar is going to lose its world reserve currency status, and it will. And people say, well, when is it going to be replaced by the yuan? China doesn't have a free-floating currency. Until one of those things changes, then I will say, well, maybe this is the end of the bull market in precious metals. As of right now, it's just a necessary sell-off that should be bought. Now, if it continues to erode, you're going to break some support here, and it might last longer. It might be a significant pullback. But at this moment, it's a very healthy correction.
Gareth Soloway, chief market strategist and founder of Verified Investing, views the recent gold pullback as a natural and healthy correction within a much larger, long-term bull market. He explains that after gold's powerful run toward new all-time highs earlier in the year, short-term technical pressures and profit-taking were inevitable. According to Soloway, institutional investors used the overbought conditions as an opportunity to lock in gains, while retail traders misread the dip as a sign of weakness. However, he emphasizes that the underlying fundamentals, inflation persistence, rising geopolitical tensions, and growing central bank demand remain firmly intact. This correction, in his view, has done nothing to alter gold's long-term trajectory. Instead, it has reset sentiment and created a more sustainable base for the next leg higher. Soloway believes that once the current consolidation phase concludes, gold could resume its upward march, potentially targeting the $4,000 to $4,100 range in the medium term. He points to technical chart structures, such as strong horizontal support near $5,000 and a long-term ascending channel that remains intact. The recent pullback, he says, is shaking out weak hands before the next surge, a common behavior seen in major bull markets. Soloway also notes that as bond yields soften and the Federal Reserve eventually pivots back to monetary easing, capital will flood into gold and silver as investors seek safety. For him, this correction is not a warning sign, but a buying opportunity for those who understand gold's role as the ultimate hedge against monetary instability. Before we dive into Gareth Soloway's sharp insights from their latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market. Let's get into it.
Let's dive right into the gold chart, comparing it to the 1979 action. So what we see is almost a perfect replication of the 1979 period. Here's your 1979 rally up, sideways, and then right here, we get 9 straight up candles in a row, followed by a big correction. Right here, same thing, up move, sideways consolidation, and 9 up candles in a row. And this is the weekly time frame. So this is 9 weeks in a row up, 9 weeks in a row up in the 79 action. And then here was what the next candle followed. Look at what's beginning to happen here. Now listen, do I think it's going to be this big of a correction? No, not in 1 week, not even close. This was a much bigger percentage move because it was coming from a lower point. But do I think ultimately gold could correct down to about 35 to 3,600 when all is said and done? The answer is yes. So let's discuss why this is different, right? So we've just talked about why this is very similar to 1979, almost perfectly identical on the charts. But why is it different? Why do I believe this is not going to be like the top being put in 1979? And why, let's be clear. In 1979, the top was put in and we corrected 71%. Gold dropped 71% from the 1979 highs. In addition, we didn't make new all-time highs till recently, right? I mean, it was just that simple. Well, not recently, but it took years and decades really for gold to make new all-time highs. Now, the kicker is this, guys, okay? The difference maker is very simple. In 1979, Paul Volcker was raising interest rates aggressively going into the 80s, right? Interest rates were up to 15, 16, 17% for the Fed funds rate, right? So again, right now, if you compare that to what's going on now, interest rates are falling, right? The Fed is just about to cut rates next week by another 25 basis points. Interest rates are nowhere near the 10, 15, almost 20% that we saw back in the early 80s. Okay, so that's very important. In addition, The debt to GDP in 1979 to 1980, you know what it was? 32%. Today, 130%. So the underlying is way different, which is important to understand, because to me, the difference maker is that yes, I think we're going to pull back just like we're seeing, like I called for, but ultimately it's going to lead to a buying opportunity where within a year or so we make new all-time highs, maybe even in less. Versus in the 70s going into the 80s, it literally took decades for gold to make a new all-time high. Don't see that happening. And again, I just laid out the case of why this time is different in terms of, and by the way, I didn't even mention de-dollarization going on. But again, other countries are massively buying gold, China, etc. The rest of them massively buying. Federal Reserve banks are buying gold. There's this concerted effort to de-dollarize, to move away from the US dollars being so reliant on it. And gold is one way to do that. And that's only going to continue. All right. The fact that the US has so much debt, that the monetary policy is so weak, essentially, or easy money, it's going to push more de-dollarization. So gold, again, likely, yes, pulls back here. We're seeing it today, but we should see further upside in the not too distant future. All right, back to the charts we go. Let's jump into silver. Look at the drop on silver, guys. Now let's get rid of this trend line. This is a potential downside target of mine, but let's go back to my call just a couple days ago. I did a video saying we could correct on silver 15 to 20%. Well, guess what? Literally 2 days later, we're already down 10% off of the highs. Amazing. Amazing how the charts are so good. And by the way, the charts aren't perfect. They are not. Please don't understand. I am wrong absolutely on occasion, right? It's a probability game. So my goal is to make sure that 75% of my calls, if I learn and study the charts hard enough, I shouldn't be right on 75% of my calls. Still leaves 25% that I'm not going to be right on. Just the nature of the beast. There's always going to be unforeseen things that occur in the charts. Now, going to this is what I laid out for you just a few days ago. Amazing parallel going back to the October 08. So the financial crisis lows here. Here's your low in COVID to your high. Look at where we topped out. Look at that correction already. Amazing. All right. By the way, we're seeing here on silver down 7%. It was down almost 9% at its lows just today. That's not even including this drop here. And if we do a measurement from peak to trough, what do we see? 12%. We were down a total of 12%. Remember, just 2 days ago, I said we were going to correct 15 to 20%. We came within 3 percentage points of my low end of the target. Now, in a worst case scenario, how low could silver go? Where will I be loading the boat? We take a classic trend line. We just use our classic trend line and we say, okay, this upsloping trend line connecting the low of April to these lows. There you go. Right around 40, just below $43 per ounce. Now, listen, we already got to 48. So again, we just went from 50, almost 55 down to 48. What's another hop, skip, and a jump to 43 or so? In addition, what we want to do is we want to take our Fibonacci tool, right? We do our fib, and what we can see is this area right here is going to be a 382. So this will continue to inch up anywhere between the 382 and the 0.5 retrace. To me, that's going to be my spot. Now, again, will I go all in there? The answer is no, because I don't do that. I don't trade that way. I don't believe that I'm never going to be wrong because it's a probability game. So if silver comes back to that level, I'm going to be nibbling on it and buying some, but I will leave myself maneuverability to buy even lower on the silver chart if it wants to go lower. Remember, charts will do what they want. They could break this level that I just showed you. If they do, they could go down another 3, 5, 10%. How do you maneuver? If your bull case stays strong, which is the de-dollarization, the debt to GDP, the Fed lowering rates of precious metals, you have to be ready to say, okay, well, in this case, how do I maneuver should it come lower as long as my bull long-term thesis remains intact?
Economist and portfolio manager MichaelPento echoes a similar sentiment, but takes a more macroeconomic perspective on gold's pullback. He attributes the recent softness in gold prices to temporary strength in the US dollar and elevated real interest rates, both of which have historically pressured the precious metal. However, Pento argues that these conditions are unsustainable given the global economy's dependence on cheap debt. He warns that once economic growth stalls and the effects of tightening monetary policy become undeniable, central banks will be forced to reverse course, igniting the next leg of the gold bull market. In his analysis, the current dip reflects short-term liquidity movements rather than a change in long-term fundamentals. Pento also highlights that central banks continue to accumulate gold at record levels, signaling that governments themselves are preparing for the erosion of fiat confidence. He views this behavior as an early indicator of a coming monetary reset, where gold will reassert its historical role as a cornerstone of financial stability. For Pento, the pullback provides an opportunity for strategic accumulation rather than panic. He expects gold to surge well beyond previous highs, once the Federal Reserve's tightening cycle ends and inflation reaccelerates under renewed stimulus.
Know that, and I know when the market has a down day, I'll hear from specific individuals who always are value conscious and they're looking to add on pullbacks. But go ahead.
So you have to evaluate, is this a trenchant watershed moment, epiphany in the precious metals market? Is the bull market over, or is it just a healthy pullback? And nobody knows for sure at this moment. God only knows, and I'm certainly not him. But I will tell you this, what has really changed? And the answer is nothing. We had a secular bull market in precious metals that went vertical. It just went linear. And in my opinion, at this juncture, this moment, it's a healthy, necessary pullback in the bull market of precious metals. Because look, I mean, here's the facts. The Fed is panicking now. They're actually in panic mode. They're not panicking to raise interest rates. They're now going to actually accelerate the monetary debasement of the dollar because they're cutting interest rates. They're going to cut again next week, second time. This is before the new chair comes in May of 2026 and who's going to cut rates even more aggressively. The Fed is ending quantitative tightening. As a matter of fact, I checked yesterday, I looked at the Fed's balance sheet. Quantitative tightening means you're actually shedding assets, so you're draining the balance sheet. The opposite is, since October 1st, the Fed's balance sheet has been increasing. So they're already in the process of quantitative easing, and I think that accelerates under the new Fed chair. It coming in 26. And then is China now selling gold to stockpile treasuries? Is Russia doing that? So I mean, so there's nothing really changed. Has the United States paid off its debt or deficits? The deficit this year is the same as it was last year, despite all the revenue that we're taking in tariffs. It's the same number, $1.8 trillion. That's not my opinion. That's a fact. So from the Congressional Budget Office. So deficits are still dangerously high. Debt is over the top. We're monetizing debt at a faster rate. So until one of those things changes, then I will say, well, maybe this is the end of the bull market in precious metals. As of right now, it's just a necessary sell-off that should be bought. Now, if it continues to erode, you're going to break some support here, and it might last longer. It might be a significant pullback. But at this moment, it's a very healthy correction.
With using the old methods.
Well, I mean, I don't have a number for you. I just know it's much higher than the hedonically and substitutionally adjusted. I mean, who cares? Does anybody invest looking at the CPI? I look at the rate of change of things. Actually, the second derivative is the most important thing to me. So it's the rate of change or the rate of change. And for me, it means that inflation is heading higher at a faster rate. So we're growing at 2.7% year over year now. This next print, whenever we get it, because the government's closed, but we're going to get a print on Friday. And I think it's going to be 3.1%. That's higher than 2.7. So the rate of change is accelerating. And yet we see the Fed, for some unknown reason, is anxious and now panicked to cut interest rates, end QT, and re-enter QE. Even though we spent 4.5 years above their silly, ridiculous, derisive target of 2%, and we're 50% above 2%, heading further away from 2%, and they're cutting interest rates.
Yeah, that tells you there's something else going on. It's always like, watch the body language. Don't listen to listen to the words just to hear what the cover story is, but not to understand what the truth is. Watch the body language.
That's why people turn to you, Dunnigan, and Liberty and Finance, because you won't hear this from the financial media. The reverse repo facility. This is basically the excess reserves from banks that they didn't need and they parked it at the Fed. And that was used to buy treasuries to make sure we had quiescence in our bond market, even though we're an insolvent nation. That was $2.5 trillion in 2022. Well, today it's effectively zero. So the Fed knows that all of that excess liquidity that the banks had parked at the Fed is now gone. So they don't want another repo crisis like they had in 2019. We're on the doorstep. The threshold, the doorstep of another one. So they're preemptively, obviating the need for that aggressive rate cutting and to, spike the balance sheet by $1 trillion. They're trying to get ahead of that by now ending QT, lowering interest rates, and rebuilding the balance sheet. It's funny that the balance sheet was $700 billion prior to the global financial crisis. It spiked to $9 trillion. They managed to get it down all the way to $6.3 trillion. from $700 billion to $6.3 trillion. And the reserves in the system were almost negligible, almost zero. And they spiked through more. As a matter of fact, I'm going to put on my web, as part of my midweek reality check this week, I'm going to put a chart up of reserves in the financial system and showed how they spiked from like zero to over $3 trillion since the global financial crisis, and then really went ballistic after COVID. And there's still, a superfluous amount of reserves in the system, and yet now they're adding those reserves. So you want to understand why people are pining for an alternative to the US dollar, and they're running into this like crazy stuff like Bitcoin. But in reality, what they need is gold and silver and platinum. And that's what's happening. So that's why I think, again, as of now, it's just a healthy pullback in the precious metals complex, which if you have the courage to step in when silver's down 8%, you might be rewarded a few weeks from now.
Looking ahead, the outlook for gold and silver remains profoundly bullish as the global financial landscape undergoes a major transformation. Both metals are expected to benefit from a worldwide move away from fiat dependence and toward real asset-backed value systems. As inflation persists, government deficits widen, and monetary credibility fades, investors and central banks alike will turn to precious metals as the ultimate store of value. Gold could climb steadily toward the $5,000 mark, while silver, driven by both monetary demand and industrial scarcity, could explode beyond $150 to $200 per ounce in the coming cycle. This revaluation will likely coincide with a broader monetary reset, where nations facing fiscal instability are forced to re-anchor their currencies to tangible assets like gold. The gold-to-silver ratio, which has long remained historically high, could collapse as silver outpaces gold in percentage terms. The next decade may well mark the end of the fiat era and the beginning of a new financial order built on hard money principles. In that world, those holding physical gold and silver will not just preserve wealth, they will stand at the forefront of one of the greatest financial transitions in modern history. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.